Okay, good morning to everybody. So today is Wednesday, day before Thanksgiving, and we're going to pick up in talking about where we left off on Monday, dealing with Chapter 17, which is the very last module in this course, and it deals with the issue of standardization. And standardization really relates, I know that we tend to sort of focus here on costs, standard costs, and that's really the focus. It's a lot of what we are doing in managerial accounting, which is why managerial accounting is sort of the step stool, the sort of stepstone, I guess, to cost accounting. But I should point out also, there are other elements with regard to standardization that has to do with standardized revenue. And what standards really are this way of sort of setting a benchmark, I guess, is the way you could say it, so that managers can assess their performance and we can hold people accountable for what they do. I think we've said before in this course that one of the benefits of managerial accounting is it really allows us to sort of understand who's doing what and more importantly, at what cost and at what time frame. And that's a lot of what's going on here. Okay, so we left off last time. Let me see. Any questions before we get started here? We have a number of people on the live Zoom call, but if anyone has any questions, go ahead. Feel free to shout out or put in the chat link, whatever you want to do. So I want to sort of pick up from where we left off last time. That was the idea of total variance. Now remember, we talked about variance, and this is something that I sort of alluded to and got into a little bit in chapter 15. And it's really, it flows out of the budgeting process. That's the idea that budgeting is an imperfect process. It's going to arrive at solutions that maybe are overly optimistic or maybe overly pessimistic. But one thing is for sure, there are going to be variances, particularly individual line items. I think that's almost a given. And if you don't have variances, that in itself is something that's very questionable because there are going to be variances, either positive, which we call favorable variances, or negative, we call unfavorable variances. And so as a result, there are going to be variances as a result. So in this case, we go back to the Zonic tonic. This is a sort of theme that kind of runs through this chapter here, if I can kind of get this to go here, where we said, and I want to sort of flip back here a little bit, that the standard cost per unit, which takes into account, again, standard cost is simply the idea that we think this is what it ought to cost us. In other words, it should cost us. We sort of underline it, put it in bold, whatever we want to do. And we said 4 pounds of direct materials times $3 per pound is $12 per unit of input. That's one element of input cost. Direct labor takes 2 hours, 2 labor hours to put together whatever this product is. And so as a result, $15 per hour is 30. And then we got to the manufacturing overhead. And a lot of this is material we covered before, particularly in Appendix F, which we assigned a driver to overhead. We said, okay, we've got to latch on something. We have to find some reasonable, rational way to attach these indirect overhead costs to individual products. And so we did it in a number of different ways. In this example, we're using direct labor, which we would call a traditional approach. 2 hours of labor. Where did that come from? It came right here, right? Because we're saying for every unit of output, we're saying 2 hours of this cost driver labor is going to be incurred in doing it. And we said $5 an hour. So $10 was the overhead cost per unit. And again, the company's selling some sort of gallons of sort of high caffeine, something that you buy at 7-Eleven or whatever. It's Zonic tonic. And so it doesn't really matter what the good question is. It's the idea of establishing the cost. So we said $52 per unit is the standard cost. The aggregate cost based upon all of the foregoing information that we have assembled with regard to direct materials, direct labor, and manufacturing overhead. Okay, and what we ended up was this. We said, okay, this is the very last thing we got to on Monday, where we said, okay, all right, so $50 per unit is the standard cost per unit, but in reality, in the month of June, okay, this is 1 month's information. So, and again, the managerial accounting can slice and dice the accounting year, however we want to do it, by month, by quarter, by week, whatever. So in the month of June, we produced 1,000 gallons. That was our quantity output. And we incurred these costs. These are actual costs. Okay, these are not projected, these are historical costs. They cost us $13,000 for direct materials, direct labor, all the way down. And overhead's broken into 2 pieces of fixed and variable overhead. And I know that we kind of went through this last time, but we were sort of at the end of the class period, but this was a pretty good jumping off point. Okay, well, if you take 55,000 divided by 1,000 units, you get $55 per unit, not $52 per unit. So we have a variance that is unfavorable variance because we're spending more per unit and in total than what we expected to. So as a result, we have a variance which is $3,000, which is unfavorable. So the question is what to do about it? Well, maybe the answer is nothing. And again, one of the things I mentioned on Monday is that I think personally that the price variances are more difficult to manage than the quantity variances are. And we're going to get into this idea of price and quantity variance, and we're going to sort of split this in half here to arrive at total variance. But and we're going to get there, okay, here in just a second. So that's the variance for that particular example. So what are variances? So variances are these things which we should welcome, I guess, maybe what was the wrong word, but expect maybe is a better word. And we're going to have variances in all these categories: direct materials, direct labor, overhead, and some may be positive, some negative. So if you sort of add this very simple equation, the variance in materials, these are dollar figures, in materials or in labor and overhead equals the total variance. And notice you can have, this can be positive, this can be negative, this can be positive, negative, negative, positive. I mean, whatever combination you want to do, is going to allow you to arrive at whatever the variance is for this particular scenario. So I think we have to be clear that there are going to be some variances that are going to be favorable, which means we're going to have a positive contribution to income, and some are going to be negative, which are going to connote a negative contribution to income. So all these things are sort of aggregated together in order to make the mix. And so as a result, this is the thing I think I left you with last time, is I would get to, this is a particular slide shot that I think you should get familiar with. I would print it, I would do whatever, I would reproduce it, whatever you want to do. But when we talk about total variance, we're talking about two different areas: dollar figures, which we call price variance. It should probably be better construed as cost variance, but it's the price that the firm pays for materials and labor. So it's price variance, a quantity variance, and together these equal the total variance. But here's how you get there. You get there by taking actual quantity times actual price. This is just a certain product minus actual quantity times standard price. That gives you the price variance. The quantity variance is this actual quantity times standard price minus standard quantity times standard price. So if we just stay back here and take a look at what's going on, because I know this is kind of busy, I know, and I've been where you are before, and I'm thinking, what's going on here? But if you think about it, what is going on is the idea that we're trying to get a price variance, because what we're comparing here, what's constant is the actual quantity, because it is what it is, it's measurable. But we're talking about the difference between the actual price that we paid in relation to the standard price. So that gives us a price variance, favorable or unfavorable. And the same goes this direction here. The standard price is constant. What we're really talking about is the actual quantity minus the standard quantity. And then we get the quantity variance. And together, the combination of both of those gives us total variance. Okay. And I know this is not the easiest slide to look at. And over the years, I've kind of come up with my own sort of mnemonic device. And I like mnemonic devices because I think they sort of are a bit of a hack in terms of getting to where you need to go. But really, I think this is a really good illustration of what's going on. Okay. And so let's put this in practice here and look at what's going on. So in this case, we're talking about the Zonic tonic, and we get actual price minus actual quantity times actual price. Where do they come from? Let's just slide back up here a minute, okay? So we're saying, okay, all right, if you take this framework where we say actual quantity times actual price, and it's what's implied here, but it's not evident, is minus the actual quantity versus times the standard price. And why are we subtracting it? Because we're trying to get to the difference. Difference always implies there's a subtraction problem going on here. So as a result, what do we have here? We have 4,200 as the actual quantity times the actual price, which is 310. Okay, now these are different than what we expected, right? We expected the standard quantity to be 4,000 and the standard price to be $3. And so as a result, we had 12,000 in cost for this for the budgeted or projected, or whatever you want to call it, standardized cost. Instead, we had 13,020. So the difference between these two is 1,020, and because the actual is greater than standard, we have an unfavorable variance. Remember, actual costs are greater than standard costs. We have an unfavorable variance. If it's the opposite direction, where actual costs are less than standard costs, it's favorable. And there are favorable examples that come up all the time. One of the things I talked about on Monday was the idea that this is difficult, particularly in an environment where prices are rising. We see prices rising, and the price variance really is difficult to manage. It really is. And we're going to get to we're going to sort of break out the two variances, and some of it's price, some of it's quantity, but price variance is, I think, difficult. I mean, what are you going to do about rising prices? Not very much about it. And by the way, it's not materials only, it's also labor. And what does the company do about that? So it's difficult. So, all right, so think about this. That's the total variance. In other words, that is this. It is this. Where did it go? Oh, I lost my slide here. Oh, I think I deleted the slide altogether. Oh my God, I think well, it's that slide I showed you. I think I hit the delete button, but it's that slide I showed you. And it's going to come back here, right there. But I'm not quite there yet. So, all right, so 1,020 is the total difference. Now, to this point, we've only gotten the one variance. Let's get to the other variances, okay? There are two sets of variances, and they're based on price and quantity. In other words, dollar figures and quantities. And so we have the total variances of 1,020. Well, let's dig into this and see what the actual causes are. And if we drill into this a little bit, we'll see just by plugging numbers in here, actual versus standard, with price and quantity, we get an actual quantity price, 13,020, which we got to before, and 12,600, which is the actual quantity, which is what was actually produced, times the standard price, which was $3, not $3.10, which was incurred. So as a result, simply take the product of this minus the product of this, you get 420 as the price variance. That's one component of total variance. It's not total variance, it's one component. It's the dollar component of that, okay? So that's what's going on there. Okay, that's part of it, but we're not done yet, because the other part is materials variance. And so if we look at materials variance, we say, all right, so we say $4,200 times $3 per unit, and we have this difference here. We have 4,000 as a standard quantity times $3. So as a result, we have a variance here. 12,600 is the actual minus the standard of 12,000, so it's $600. And this is unfavorable. And both in this example tend to be unfavorable. So we have materials price variance of 420 unfavorable. And I know the dollar figures may not be overly impressive, but we talk about the idea we have 420 unfavorable for materials, 600 unfavorable for quantity, and that gives us the total materials variance of 1,020. That's just the materials part of it, okay? And again, as I mentioned on Monday, and I think before that even, that a lot of the internal reporting that we do in managerial accounting just goes on and on, and it lists various individual areas. And remember, let's not forget what the purpose of managerial accounting is to sort of inform management as to what's going on, to summarize what's happening, and what's interesting and necessary is this is more or less real time. It's not exactly real time, but it's pretty darn close, right? And managers increasingly are liking visuals and what we call dashboard reports, where they get it in fairly quick order, and so they can see, hey, we got a variance. And if it's unfavorable, then it sort of necessitates intervention. And what intervention is up to management, but it's their firm, so they have to do it. So again, and this kind of brings us back to this slide that I mentioned earlier, and I think it's totally important because it sort of lays out not only the sort of schematic as to what are the flow of costs and how they line up versus standards, but also they sort of take the equations and we can sort of plug the numbers in. We have actual, and we have actual quantity and standard price. We have actual quantity standard price and standard quantity standard price. So we get two variables, two variances, price and quantity, and they can offset one another. There's a push-pull going on here. Okay, we get a very positive quantity variance and a very negative price variance. It's not unheard of at all, right? Or the vice versa. And the question then for management is what to do about it. If we're not happy, now for a $1,000 variance, we're probably pretty happy, I guess. But what if we sort of, as I've said before, what if we tacked on some zeros to all these numbers, maybe not so happy. And so as a result, we have to maybe think about what we're going to do about it. And that's really part of the trick as to where we're going. Okay, so that's the issue. So we talk about materials price variances. What are we really talking about here? And what are the factors that can be under control of management? Number one is the issue of discounts. And sometimes discounts are available, sometimes they're not. I know most students took Business 1180 at one point, which was business math, where we talked a lot about discounts. Both trade discounts, which were offered for who knows what reason. It's mostly in the minds of the seller. We have a new product we're going to introduce. We're going to give you a discount on it. You're a good customer. We're going to give you a volume discount, whatever. That's one category of discounts. The other category is cash discounts, which means we take a discount on the invoice because we paid early. Well, we as a buyer, we as a company. But the problem is cash discounts are always available, nor are trade discounts for that matter. So these are completely under control of the seller. Yes, there's negotiation involved, but how do you budget for that, right? How do you budget for discounts? It's really difficult, and discounts sort of seem to arise for whatever reasons. And I maintain that really where they come from is from the desk of the seller, not so much the buyer. But we're a buyer here, right? We're buying quantities of materials, and so how do we budget around discounts? It's difficult, right? And so sometimes we may get discounts, and sometimes we may not. So I think that's one of the questions. Also, the issue is how much we are going to be purchasing from all suppliers, all buyers, all suppliers, all the way across the line. And we don't know if price increases are going to be a factor. And as I've mentioned a couple of times before, we're sort of in a bit of an inflationary environment where prices are going up on lots of things, and it's really hard to budget. And in fact, when I was an econ major in the late 70s, early 80s, I guess, and one of the things that economists were sort of struggling with was the idea that prices are rising so quickly. It was really difficult for firms to do budgeting, because how do you budget when prices are going up and up and up? You really don't know what the prices of goods are going to be. And think about this, it's not one goods, it's the multitude of goods you're buying. And who knows what's going up and what's not going up, right? And things aren't going down. I guess that's if that's cold comfort, I don't know, but things are going up, and so how much and in what direction and on what products, it's difficult, which is what makes the budgeting process difficult, and the assignment of standard costs all that more challenging. Okay, so I've been doing this for a while. I know that for a long time, really inflation was not really a concern, but it is now, and I know you look on the news and everyone's talking about inflation. It's coming down. Yes, it has come down, but it's still at levels that require some fancy dancing, I guess, on the part of management. Okay, so what are the causes of price variance? Number one, this whole issue of quantity discounts and discounts that are available, the quality, and that's going to sort of tie a little bit over into the quantity variance, and also what delivery method and how we get the goods and whatnot. So these are all price variances. Now, one thing I will say, I said it at the outset, is that I think that the price variances are more difficult to manage than our quantity variances. I'm a firm believer of that, and I've seen the difficulties in trying to get to the point where we're trying to manage price. I mean, what prices are we trying to manage? We're trying to convince sellers to give us lower prices. Okay, good luck, right? Trying to convince workers to take lower wages. Definitely good luck with that. We haven't gotten to the labor part yet. These are difficult. Quantity is really more about efficiency and how much we produce and how much or how little we waste. And I think that's kind of where we're going. Okay, so when we talk about materials variance, and we'll move on to labor here in a minute, it's the idea that we're talking about variance is due to what? The quantity variance, which is what I mentioned a minute ago, are due to all kinds of things. Inexperienced workers, as we need to train workers better. And there are some workers that simply aren't trained very well, and that's part of the problem. And training is an important feature of management. We don't cover it much in this course, but I can tell you that workers who don't know what they're doing are pretty substandard workers. And it's not their fault. They're not bad people. The deficiency lies in management. And I am one who always thinks management is responsible. Whatever goes wrong, blame it on management. I always blame it on management because management should be responsible, and they are responsible and accountable for what goes wrong. So inexperienced workers, bad machinery, that happens, downtimes, whatnot, or whatever. So all these are responsible for the quantity variance, which I think is much more manageable than is the price variance. But then again, there are differences and difficulties in managing all of these. Okay, so any questions about anything before we go on to some examples here? We'll go to the labor piece in a minute, because we talked about direct materials, and we talked about the fact there are two different elements of variance. That is the price variance, which is a dollar figure, and the quantity variance, that's direct materials. We'll get to the labor piece in a minute. Okay. Before we do that, though, let's talk about an example in the text. And I like this example because it's pretty straightforward, and it's actually relatively easy to compute, but it kind of gives us sort of a window in how we do this, and that is the idea of calculating variance. I'm going to sort of take this up here if I can, and this is the example of the book. It's do it number 2, direct materials variance. And the standard cost of Wonder Walkers is, I'll take this out over here, is 2 units of direct materials at $8 per unit. So it's very helpful in the fact that they've sort of broken down what the costs are and the materials, and the required materials. And during July, so it's 1 month period, the company buys 22,000 units of direct materials at $7.50 per unit. So immediately we've got a reduction in the price variance, and so we're thinking, okay, great, $7.50 is lower than $8, good, right? And we use those materials to produce 10,000 Wonder Walkers. That's the quantity amount. So the standard quantity is 10,000, and it's times 2 units of whatever the direct material is to whatever the unit question is. Okay, so let's kind of do the math here and see how this might work out. Okay, and I want to go back to that particular slide that I told you to print or whatever with. And let's talk about this idea of variance with regard to this. Okay, so we're going to compute both price variance and we're going to do also quantity variance. So we're going to do both of those, and we're going to sort of take the difference between those. Okay, so let's talk about direct materials. And remember, the formula here is actual quantity times the actual price. Okay. Minus, that's the one block there on the left, minus standard quantity, and times standard price. That's going to be the total variance, and we're going to get to that in a second. Okay, we're going to come back to this. Let's come back to that in a minute. Let's do materials first, okay? And we're going to talk about direct materials and direct labor. The reason I'm going to come back to that is because, remember, the total variance is really the aggregation, what the difference is between direct materials and direct labor. We're not into overhead really at this point. So in this case, what is the formula? Basically, that we've taken from the original formulas: actual quantity times actual price minus actual quantity times standard price. Okay. All right. So that's what's going on. And again, the standard values were arrived at some point in the budgeting process. So what are the numbers? Actual quantity, we produced 22,000 units, right? And we did it at an actual price of $7.50. Remember, the standard price was $8, and so we're thinking immediately, okay, great, yeah, lower price, okay, that's good, right? And the actual quantity again is 22,000 minus that standard price, and so we have a variance here. It's $8, right? We've taken the math here. 22,000 times 750 is going to give us 165,000. Minus 176. So the actual is less than the standard, which we say is a good thing. And so as a result, we have a variance. It's $11,000. And we're simply going to label that as variable. Okay. Because why? Because the actual is less than the standard. Okay. So it's a variance in the good in this case, right? In the positive direction. We expended less than what we had thought we were going to do. But I think sort of the one thing that sort of leaped off the page for me was the idea that we have a huge price variance on a unit basis, 50 cents, which may not seem like very much, but you're talking about 22,000 units on 1 month, right? So it's significant. So that's one element of variance is the materials variance. Let's talk about labor. Okay, we talk about the labor variance. What are we really getting at here? I'm sorry, the quantity variance. I'm sorry, this is not direct labor. This is direct materials. This is price, and direct materials. This is quantity. We're not really getting at labor yet. My apologies. Sorry about that. All right, so we're talking about direct materials price, direct materials quantity, just materials. Okay, we'll get to labor in a second. So what's the formula here that we want to look at? We want to take the actual quantity times the standard price, which is this guy here. That's the second box in the middle there. Actual quantity times standard price minus standard quantity times standard price. And that's the formula that we're going to use. And we have all the figures given to us in this case. And it's basically actual quantity is 22,000 units. And the standard price wasn't 8, it wasn't 750, it was 8, right? That's what we thought we were going to spend ahead of time, minus the standard quantity, which we thought we were going to do 20,000 units. We did more than that. And the standardized quantity was 8. And as a result, we simply do the math here, we get 22,000 minus 8 times 8 is 176. These are all dollar figures, minus 20,000 times 8 is 160. These are zeros. My zeros aren't very good. As a result, what do we have here? We have a variance of 16,000. And because the actual is greater than the standard, we're going to say it's unfavorable, right? So to put both of them together, what do we have here? We have an unfavorable variance, and it's going to be 5,000, right? The math is easy. 16,000 unfavorable minus 11,000 favorable means we have the weighting here is on 5,000 unfavorable for the month of June. That is the period in question, right? Now here's one way that we can sort of do the hack here is, what if we simply put these together and said, okay, this is the total variance, right? We're going to take actual quantity, which was 20,000. We're going to get the same number, I promise you, times actual price, which is 750, which is the actual price, lower than we thought, right? Standard quantity was 20,000 times $8, which is the standard price. We do the math here, and we get what? 22,750 times, 22,000 times $7.50 is $165. That is minus 160. And as a result, we get what? We get a difference of 5,000, which is same as what we got here. The math is not hard. 16,000 minus 11,000 is 5,000. And what is it? It's unfavorable because the actual is greater than the standard. So remember, when actual costs are greater than standard costs, it's an unfavorable variance. Okay? When it's the other way around, when actual is less than standard cost, it is a favorable variance for whatever category of analysis we're looking at, not just materials, but also labor and whatever else. Okay, all the way down the line. And these are, again, internal reports. These are all dollar figures, right? Dollar figures. And this is one reason. So when we earlier on said that, I know the textbook authors sort of went to great pains to differentiate standardization versus budgets. The standardization process really flows out of the budgeting process so that we can assign dollar figures at some point. So this formula is in your text somewhere. You can look at that, but that's kind of an example. I like that example. It's quick and easy, and it kind of brings us to the idea that we've got variances in one thing, but maybe one way and another way, and they sort of balance themselves out. In this case, right, we had a favorable variance that we were all clicking our heels and say, great. But we have an unfavorable variance, which outweighs that. So as a result, total variance is unfavorable. And then the question is, and it's sort of beyond the scope of what we're doing here, what do we do about it? And that's really up to management to decide what, if anything, to do about it, right? And it's this could be a product that we need to get to the market immediately, and so we don't really care so much about these grades. Remember, the internal reports, these are not GAAP, this is not GAAP income statement reporting, and so this is just for us, right? So when I say for us, for management, so it's really up to management to decide what to do about it. Okay, all right. So any questions about this example here before we sort of move on? And let me see here. I'm trying to check out the. Doesn't look like there are any questions in the chat box. So let's go on to the next section, which deals with labor and also overhead. So we talked about materials, and even I kind of got myself a little bit confused there. We were talking about direct materials and price and quantity variances. And remember, these two different sets of variances are simply the math of dollar figure variances versus plan. Sometimes you might hear a term called plan or standard or budget or whatever, and also quantity variance. And the same goes with labor. And in many cases, labor price variances are difficult, I think, to manage. I said that before with materials, but I really am much more assertive in the idea that wage variances are really, really difficult to overcome. So, all right, so let's talk about labor variances. And again, we go back to the formula and just go back to that one slide that I had where I talked about actual versus actual. That's actual quantity and price. Now remember, to make I know we confuse things a little bit because we have hours, which is a quantity, and a rate, which is a dollar figure. And we often don't refer to A as the price of the good, but it is the price of the good. In this case, we're saying, all right, for whatever we're doing here, we had 2,100 hours incurred to make whatever the output level was. And I guess the output level was, what doesn't really say, but these are input values. And the rate was $14.80 versus the standard rate of $15. Immediately you might think, okay, great, we save 20 cents per hour on labor, but we've incurred more units of labor hours worked than what we expected. So as a result, we have an unexpected variance of 1,080, and that's an unfavorable variance. And unfavorable simply means we've incurred more costs than what we expected. And so as a result, that's a negative in the overall sort of scheme of things. Okay. So let's go with labor variance as to this. Now I think labor it's fairly easy to sort of tease out. And one of the reasons why is all this is very easily obtainable. And it's available to us in a very quick order, right? I mean, and I've said this many times before, but the idea of labor costs are I think, relatively easy to ascertain because it's really there for us. We've long been able to sort of capture labor rates. But the idea of comparing it against the standard is one thing. This is the total variance. Now, total variance, which is sort of the aggregate of the price and materials variance. Let's sort of drill into this a little bit and talk about what the components are. So, all right, total variance then, like we discussed with regard to materials, is this idea of the price variance. This is just the labor piece. Labor price variance and labor quantity variance gives us total variance. In this case, we said that we had a total variance of what was it, 1,020? I want to say 1,000. Wait a minute, 1,080. All right, 1,080. So let's talk about the components of this. It was 1,080. All right, so what are the components? Let's take the price variance first. The dollar variance. Okay, this is and again, I know that it'd be nice if the text didn't sort of mix up these sort of letter representations. This is quantity, this is price, this is quantity and price, all the way across. And so this is just the price part of it, where we say we incur 2,100 hours in the month of July, I think what it was, at $14.80. So we have $31,080 as a budgeted amount of labor. However, we expect to employ less labor, or the same amount of labor actually, at $15. And so as a result, we have a favorable variance, right? It's a good thing, right? And the key marker here is this: same number of hours employed, but lower wage cost. For whatever reason, we don't know what the reasons are. Maybe somebody who was very senior and a high wage retired. Who knows? It doesn't really matter. But we take the good news as that comes, and sometimes it's offset by bad news. And In this case, it's not really that bad news, but it is what it is. And so in this case, the quantity variance is the idea of taking the former formula, hours, and this is just labor, right? Hours and standard rate, which is 31.5, versus this is the actual versus the standard, 2,000 hours. We thought it was only going to take 2,000 hours, instead it took 2,100 hours. The price was the standard price of 30,000. So we get a $1,500 variance there. So the 420 that we just talked about was positive, is sort of dragged down a bit by the quantity variance. And the culprit here lies the actual quantity employed, in this case labor. It took us more labor hours to do whatever it is we're doing. So as a result, we have an unfavorable variance. Okay, all we're doing is adding this up. These are not particularly onerous math problems, but they are sort of indicative of what we're doing. And so I come back to this, and again, I really like this as a sort of schematic to sort of lay out what the issues are with regard to overall cost. And that is, you get the idea of total variance, which we determined to be 1,080, but it was the combination of 420 favorable. This piece here, the price variance, and the savior here was the lower actual wage costs incurred, right? Versus here, where the culprit is, we have a negative that offsets the positive, unfortunately, which gives us an overall negative. And it really has to do with the actual hours that were incurred, which were greater than the standard hours. So it took us 100 more hours to do whatever it is we thought we were going to do. And so we come back to the idea of efficiency here. It's up to management to decide what to do about it. And I personally, this is my opinion, you don't write it down. I think this is much more difficult to manage. This is much easier to manage because it may be a training issue. It could be an efficiency issue. There could be lots of scrap. There could be lots of downtime. There could be people taking 3-hour lunches. I don't know. I mean, we're not there to sort of drill into what's going on, but this is the numbers. And as we say, the numbers really don't lie. And management by the numbers is an important feature of the corporate world today. And so, again, we want to sort of burst the bubble that managers are not accountable, because they really are. Okay. So, all right. So that does it for labor. So we talked about materials, we talked about labor, and sort of sets the stage then for what's next. Well, it's overhead, right? So before we do that, though, let's talk about some of these labor variances. And so why are the price variances happening? I think that's a good question. It could be overtime, you need higher temps. Who knows? It could be misallocation. It could be poorly trained workers. Who knows what's going on, right? So who's responsible? We would say the labor employers. The production department is largely responsible for that, for the most part. But they're not really that responsible, in my opinion, for price variances. Instead, really it relates to an issue of efficiency, and that is, how do we work better, and can we cross-train the workers better? Cross-training is simply this idea of simply training people with other job responsibilities. This has been going on forever. In fact, one of the things that people often talk about is, how do I get a job in this area when I haven't worked before, and every employer wants experience? Well, how do I get the experience? It's sort of this catch-22. How do I get experience if nobody will hire me, right? And one way to do it is moving out within an organization and being cross-trained in that area. It goes on all the time. It's been going on forever. And that is, why hire somebody if you have somebody else who's competent and can be trained to do something different? And so as a result, they can put on different hats and do different things. And we do it around here, right? We do all kinds of different things. I mean, it looks like all I do is teach, but I do other things as well. And so to the extent to which I can be flexible is a good thing for the organization. And that's one of the benefits where we can maybe improve the variance. If the variance is unfavorable, or even if it's favorable, we want to improve it even more, right? Based upon the budgeting process. But there are all kinds of issues that go on. Maybe short staffing that leads to inefficiency, illnesses and whatnot. And by the way, I think I wrote this well before COVID, and nobody really thought of a global pandemic, I guess. But these are things that we should take into account, that they're there. So all these things are more or less controllable, and I know that depending on who you ask in management, some people will say it's all controllable, some will say it's not controllable. But I will simply say, if we break this down into dollars and quantities, I think this is a much more manageable piece. Particularly this idea of retraining workers, and it's good for the worker too, because they can move up and do different things. keeps them organized and keeps them happy. Okay. All right, so we talked about direct materials, direct labor. Now it's on the final product category, product cost category. It's overhead. So what about overhead? It's the difference between actual overhead costs and overhead costs that are applied. Remember, the application of costs based upon the hours allowed for the amount of goods produced. Now remember, this example that we're looking at here is not a activity-based example where we looked at machine hours or inventory moves or setups or whatever. It's just labor hours. That's good. And that's fine. I mean, I never, sort of denigrated the use of labor hours as a cost driver that we can hang our hat on to attach to product costs. It may not work that well in manufacturing. Sometimes it does, sometimes it doesn't. In the service industries, it works very well. So in this case, we have to arrive at whatever the overhead is, whatever we think is going to be going on for the year, and we're going to bring it into variable fixed. And again, we go back to this idea of cost behavior, where variable costs vary up and down in proportion to the level of output, and fixed overhead does not. Overhead, these are all indirect costs, all these things which we previously defined as being overhead or indirect costs. And so as a result, what are we looking at here? So if we take the Zonic tonic example, the company makes the high octane caffeine product, we have actual overhead, which was basically the idea of the budget amount ahead of time, right? And we incurred 6,500 plus 4,400, and it's based on whatever's going on, right? It's so we get 10,900 in overhead costs based upon the assumed budgeted overhead that we're incurring based on labor hours. The overhead applied though was $5 an hour. I'm sorry, $5 per labor hour, and we had 2,000 hours incurred in the month of June. So as a result, we had actual incurrence of 10,900. We had only budgeted for 10,000, so we have a variance of 900 unfavorable. And I know that a lot of the examples in the text point to unfavorable examples. I'm sorry for that, but it just kind of is what it is. And it kind of goes to this idea of what's discussed earlier in the text called management by exception. That is, you hear from managers when things are going wrong, as opposed to going right. It's the way the world works, right? We like to get pats on the back and all that, but we get that occasionally, but we really have attention being drawn when we have a variance in the wrong direction. So in this case, overhead is I don't want to say out of control, but it's a pretty good percentage of overhead costs. And so as a result, the standard hours, which is this, is the idea of what should have been incurred for whatever we did in terms of production. That is, we incurred 2,000 hours. Remember, the driver here on overhead is hours, labor hours. So we were supposed to incur 2,000 hours. We did a little more than that. So as a result, we had more hours than necessary. So we have an unfavorable variance. And that's the issue with regard to variance. And then we kind of get to this other area that I want to talk about that relates to controllable and uncontrollable. I've sort of been opening the door to this a bit throughout this class period, is the idea that some things are more controllable than others. I think that it is a fantasy to believe that managers control all costs. I just don't think it exists. I think there are costs that are controllable and they can deal with those. Others are not controllable, and to say they are controllable is difficult. And look, I was a commercial lender for a lot of years. We had companies that were my clients would say, I'm not going to raise wages. I'm just not going to do it. I'm not going to give them a pay increase. And workers were leaving in droves. They couldn't figure out why. The reason they couldn't figure out why is because they were trying to control something which is not really controllable, or less controllable than the quantity. I would much more be concerned about efficiency in terms of quantity than I am than anything else. And so in this case, we're going to talk about variances and what we call controllable, and we're going to talk about the case of price and quantity. Okay, so overhead variance is analyzed through both the same prism of price and quantity as we did with direct materials and direct labor. And so we're talking about whether it's effectively controlled in terms of price. But here we're saying, okay, it relates to whether fixed costs were under or over applied during the year. So one of the issues here, it's a big factor in this discussion that is launched about controllability is fixed costs. And what do we do with fixed costs? Remember, all fixed costs are those which usually relate to either personnel in terms of salaries or some sort of fixed asset like equipment or machinery or buildings or whatever the case might be. And so as a result, some of this is difficult to manage. It's difficult to manage. And that's why fixed costs are, in the short run, which is really more or less our point of view here, are difficult to manage. Okay. So what are some of the causes of variance? Let's walk through them a little bit. Number one is over or underspending on all kinds of overhead items. These are indirect labor, electricity. These are variable items. Can we dial down our usage of electricity, turn lights off and whatnot? And I know that sounds ridiculous when we talk about a business that earns millions a year, but the idea of leaving lights on is it's a pet peeve of a lot of people in accounting because it burns up cost and does nothing. And I know that even at home, I turn lights off all the time, right? Because it doesn't do anything, right? There's nobody's in the room, turn the lights off, right? But that's one factor. It seems piddly, it seems like we're being picky. Maybe we are, but all these add up to savings across the organization. Maintenance on machines, it's better to keep machines maintained. One of the things I was talking about in the class earlier about going to grocery stores, and invariably you get a shopping cart, the wheels go in different directions. And it's because they simply don't maintain them. All you have to do is oil those wheels. There's no big deal. They're not particularly complicated pieces of machinery. But probably 2 out of 3 shopping carts you get are going to go one way, they're going to be stalled. And it's because they're not doing maintenance on these things, right? And that's an example. It's maybe a silly example, but maintaining is important. And I had a customer back in the day who was a huge freak when it came to maintenance. He said, maintenance is the key. He said, you own a trucking company. And he said, these trucks can go 1 million miles. These 18-wheelers, I can get 1 million miles out of these 18-wheelers. But I got to maintain them. I got to change the oil and transmission and all that. And I'm constantly maintaining it. And as a result, he had really good performance. Mostly because of the fact that he was managing the quantity issue, right? That's how much quantity can we get out of these machines. And by the way, at some point we'll be done paying for the machines and it's just money in the bank. It's just chalk it up, right? So that's one issue there. Also, how we manage this. And this is sort of an interface with what we call operations management, how efficiently we move products through the production process, all the way from shipping, from receiving to the warehouse, to requisition, to being employed. How efficiently can we do that? And then lack of sales orders, that kind of goes without saying as to why that could be a variance. Okay, all right. So I don't want to get too far ahead here because I want to leave something for Monday, but I do want to talk about this idea of an example, and that has to do with variances. And so if you look, the do it 3 cutaway before the next segment is a different product. It's a different example. Standard cost. A product YY includes 3 hours of direct labor at $12 per hour. And the predetermined overhead rate, that's the standard, was $20 per hour. So it's quite a bit of a difference, right? And during July, so the period's defined, the company incurred 3,500 hours of direct labor at an average rate of $12.40 per hour and 71,300 of manufacturing overhead. So we have the labor and we have the materials. Well, we have the labor, we have the overhead, okay? So in this case, we want to do the labor, just the labor variance, okay? So let's compute the variance in this particular example. So what do we have here? So we simply take the formula that's been given, where we have actual, which is 3,500 hours, right, of direct labor, and the average direct labor rate per hour was $12.40, right? That was the actual. Then we have the units produced was 1,200, it cost 3 units of direct labor, so 3,600 hours incurred. That's the quantity issue times, and we have $3,600. I'm sorry, 3,600 units times $12 per hour is 43.2. So we have a variance here that compares 43.4, what we think based upon what we expected to do and the expected labor price, and we get a bit of a variance. It's $200. Okay. And if it's $200 in real life, maybe that's a big thing, maybe not. But it really is, it's information management. So management can do what it is they want to do with that. Okay. So that's kind of an example of how we take labor based upon some examples given and what the standardized rates are going to be, and we're going to go from there. So the price variance we see here, we have a variance. The total variance is 200, but let's drill down into the two variances. There are going to be two variances. One is price variance 1400. Where's that come from? Comes from right here, right? We had 43.4 versus 40 was a 4200, and as a result, that's part of the price variance. And then take that variance, and we have a favorable variance in terms of quantity. We use less labor than what we expected, but the bottom line is we balance these out, and we have a variance, a total variance, which turns out to be unfavorable by a little bit. Okay, and that's really the point that I think we want to make, is the idea we have unfavorable variances in one category, favorable, they sort of balance themselves out. And I mean, depending on how big these variances are and in what direction, it could be that things are considered to be fine by management. And I think sometimes management likes to hear news where the variances are small. So, all right, so that's kind of an idea where we're going. All right, so when I think I'm going to stop today here, and I'm going to pick up from the next segment, which is number 4. We have 2 more segments in this module to go over, and I'm going to talk about that on Monday. And when we come back on Wednesday, which is our final week of the class, I'll talk more about some of the examples from the back of the chapter. I know I'm sort of ending up a little bit early today, but I kind of want to keep my sections all together because we're missing all our Thursday sections are out, so I want to kind of keep you all in the same direction. So I will talk more about the issue of variance. In particular, I want to get to this final bit, which is really sort of the sort of add-on, and it kind of leads into management in general. For those of you who are business administration majors, you'll probably be more interested in this issue of balanced scorecards. It's a way of assessing management performance. So we'll start with this on Monday next week, and then Wednesday we'll get to some of the problems exercises. I'll also talk about the exam. The exam will be available. It's just going to pop up available in Brightspace on, I think, Friday, which is the day after Thanksgiving. You can take it whatever you like, and go from there. Okay. So, any questions from anybody on the Zoom call or otherwise? Okay. All right. Well, everyone have a great Thanksgiving, and I'll see you next week. Okay.